Hello, I'm Haider Malik, host of the Mehmi Financial Group podcast. Today's topic is warehouse partner buyouts financing in Edmonton. Taking full control of your logistics operation by buying out a partner can streamline decision making and accelerate growth. But structuring the right financing is crucial to preserve cash flow and avoid surprises. Here's how Edmonton warehouses can execute a partner buyout smoothly. 1. Define your acquisition structure. Asset purchase versus equity purchase. Asset purchase. You acquire trucks, racking, equipment, leasehold improvements, and contracts, leaving legacy liabilities with the exiting partner. Easier due diligence, but may disrupt customer relationships if contracts need assignment. Equity purchase. You buy the partner's shares in the operating company, stepping into all assets and obligations, preserves vendor-customer agreements intact but requires deeper legal and financial review. 2. Valuing your partner's stake. 1. Financial review. Analyze the past 2-3 years of EBITDA, normalize for one-off owner draws, personal expenses booked through the business. 2. Valuation method. Logistics firms often trade at 4-6x adjusted EBITDA or based on a percentage of equipment and leasehold improvement value plus a goodwill multiple. 3. Goodwill and intangibles. Factor in location premium, proximity to 16 Ave Yellowhead, key customer contracts, and fleet condition in your final offer. 3. Layering your financing. Senior acquisition loan. Covers 50 to 70% of buyout price, 5 to 7 year amortization at prime, plus 1%, underwritten against pro forma cash flows and equipment collateral. Seller financing. Exiting partner carries 10 to 20% of purchase price on a promissory note, repaid over 3 to 5 years at agreed rate, e.g. prime plus 0.5%. Reduces your upfront cash requirement and aligns seller on post-close performance. Working capital revolver. Revolving lines secured by receivables or inventory, bulk rental income, pallet surcharges. Draw to cover integration costs, fleet rebranding, system migration, interest only on used balance. Equity injection. Your own funds or co-investor capital, 15 to 30% of price, to demonstrate skin in the game and improve lender leverage metrics. 4. Due diligence essentials. Contract and lease reviews. Confirm landlord approval for new ownership, ensure customer service agreements and carrier contracts can be assigned without penalty. Equipment and site inspection. Verify condition of forklifts, trailers, racking, yard paving, and environmental compliance. Maintenance logs boost collateral value. Staff and union agreements. Review collective agreement terms or key employee contracts to secure operational continuity. 5. Structuring covenants and protections. Debt service coverage. Model combined cash flows post-buyout. Target 1.25x coverage on senior debt. Escrow and holdback. Retain 5 to 10% of proceeds in escrow for 6 to 12 months to cover any post-closing adjustments or indemnity claims. Non-compete clause. Include a reasonable radius, e.g. 10 kilometers, and duration 1 to 2 years to protect your newly consolidated business. 6. Integration and execution roadmap. 1. Letter of intent. Lock in headline terms, price, structure, due diligence scope, exclusivity period. 2. Due diligence, 30 to 45 days. Complete financial, legal, operational reviews, finalize term sheets. 3. Commitment and closing, 60-90 days. Secure financing commitments, draw funds, transfer ownership, and execute sale and purchase agreements. 4. Post-close integration. Rebrand fleet, harmonize WMS and billing systems, hold team meetings to explain changes and retention incentives. 3 action steps. 1. Build your pro forma. Prepare combined financial forecasts, revenue, expenses, debt service, and verify covenant compliance under stress scenarios, 20% volume dip. 2. Engage advisors. Retain a corporate finance lawyer and a logistics-savvy accountant to navigate valuation, structuring, and tax implications. 3. Solicit competitive bids. Request term sheets from at least 3 lenders, major banks, credit unions, and specialty equipment financiers, and use them to negotiate the best rates, covenants, and flexibility. By blending senior acquisition loans, seller financing, a working capital revolver, and equity, backed by thorough due diligence and proactive covenant structuring, you'll finance your partner buyout in Edmonton's warehousing sector with confidence, preserve liquidity, and position your expanded operation for efficient, profitable growth. I'm Haider Malik. Thanks for listening.